content. And a lot of people make just elementary mistakes when it comes to dividends. And I want to share you with today how not to do that. All right, so remember, a dividend, let's just get a history of the dividend. So dividends represent about 40% of the overall return of the markets historically. Let me make sure that's, yeah, there you go. All right, so about 40% of the historic return of the markets. Historically, dividends pay about 4%. So if the markets yield 10 roughly, if the return, total return has been 10, and 40% of that is dividends, that means the dividends average yield has been about 4, which, makes sense. The problem with dividends, and why a lot of the dividends are not being paid out as much anymore, because right now the yield's about 2.1, maybe 2.2, so roughly half of historical numbers, is because dividends suffer from double taxation. The corporation who earns the income in which to pay the dividend pays tax as part of the profit to the shareholder, right? So the corporation earns $100,000 profit, $50,000 of that $100,000 gets paid in dividend. They got to pay taxes on the entire $100,000. They don't get to write that $50,000 off as a business expense, essentially because it's a return of the profits to the rightful owners, which are the shareholders. The problem, though, is the shareholders get it, and they also got to pay tax on that $50,000. So dividends have tax twice. Thankfully, because of 2000 is, I keep saying 2006. I don't know if that, maybe it was 2003. It's a 2003 Bush tax cut. It was 2003. Dividends were taxed, most dividends, as qualified. So 15% is qualified dividends. But still, if you're Mr. Joe Schmo and you have $80,000 of income, you get a $50,000 dividend check, that's taxed at 15%, which is basically is actually more than your tax bracket today if you're married filing jointly. So while they're favorable to ordinary income, in fact, sometimes they're not. It just depends on your tax bracket. At the end of the day, it doesn't matter. They're still double taxed. They're taxed the corporation's profit. When the corporation makes that money, they got to pay tax as profit, and then they're taxed when they send them on to the shareholders as well. Debt, on the other hand, the interest that a company yields or pays to their bondholders, all right, so they issue a $100,000 debt, it costs $50,000 of interest. That $50,000 is taken off the bottom line. It's just all there is to it, or I guess taken off the top line, whatever line that is. But at the end of the day, it reduces their net taxable income, that $50,000 of debt, because they get to write off the interest. So they get to write off the interest, which goes to the bondholders, but they don't get to write off the dividend income, which goes to the shareholders. So what a lot of companies are doing, is to reduce their dividends because it's taxed not as favorably as interest, or certainly not taxed as favorably as capital gains. So if they have a net income, what they'll do is they'll take that dollar of net income, and instead of paying out to you as a shareholder, what they'll do instead is they'll buy back a share. Because a share, if they buy it back, basically what they do is they take that off the publicly traded market, they put it in their treasury, which means it reduces the supply of the stock out there. And anytime you got supply and demand, the less supply you have, even if demand stays the same, the higher the price goes on what is still out there. So simple supply and demand here. They're reducing the supply, even if the demand stays flat, but a lot of times the demand will go up because they're reducing the supply, because a lot of people know what that means, that the share price most likely will go up. And so when they do that, they say, okay, we got $100,000. We're going to reduce by $100,000 the number of shares that's outstanding. That should give us a little bit of a bump in stock price. You as an ultimate shareholder say, okay, you might sell your shares at that point, or you might not. But if you do, it's taxed as a capital gain. The company only pays tax on the income that they receive in which to buy back the shares. But you are now taxed as a capital gain, which is more favorable in today's day and age than being taxed as a dividend, potentially. All right, but it also gives you the opportunity. You don't have to sell it. You can let it ride in an unrealized capital gain, a deferred capital gain. You don't pay any tax until you sell it, as we talked about in other videos I've done about capital gains. A couple things with capital gains, unlike dividends. You don't have to pay any tax. You can decide, I don't want to sell this dog, and I'm just going to let it ride. At your death, you transfer it to your daughter. Your daughter inherits it tax-free, as long as it's not an IRA. All right, but if it was an IRA, it wouldn't be taxed when it's sold anyway. But either way, so you say, I am not going to sell this thing today. I'm going to hold it till I die. At my death, my heirs inherit this stock and it's tax-free because of what's called the step-up and basis rules. 2, the stock might go up, then might go down again. And when it goes down, you say, okay, well, I'm going to sell it now, and the capital gain might be minimized or lost or even a loss. So you might have reduced your capital gain because of a drop in share price. It might have evaporated, or now you have or you could have a loss, which you could sell it in which to use against other gains from other stocks that you have. So a capital gain gives you a whole lot more that you can do than a dividend. And lastly, with a capital gain, you can just transfer it. If you have unrealized gain, you can just transfer it to a charity, and it's not taxed to you as capital gain. The charity can quickly sell it, receive the cash. That's not taxed to them either. So those are 3 options when it comes to capital gains. When you receive a dividend, your option is one thing and one thing only: pay the tax. That's it. There's no other option on that. So companies given the dividends the least favorable of all these things, dividend payouts have been reduced. We see payout ratios, I think it's less than, I don't follow that much, but less than 33% on average. Don't quote me on that. And a payout ratio simply is if a company has $100,000 of net profits and they pay $50,000 of that to their shareholders in dividend, that means their payout ratio is 50%. They're literally paying out 50% of their net profits. Anytime you start getting above 50%, you got to wonder if that dividend is sustainable or not. Generally, 33% is, or anything under 50, but 33% or so is a good payout ratio. That means they're keeping 66% of the money, giving a third of it back to the shareholders. There's no right or wrong on that, but generally, if the payout ratio is above 50%, you just got to wonder if that's sustainable, simply because when the profits get reduced, or if there are no profits, when they go and they're not making any money, they turn a loss. Maybe they could have liked to have kept some of that cash in their treasury account, essentially, in which to use to fund operations. There's a lot going on in that, but just remember, if you see a payout ratio more than 50%, you just got to wonder if that's a one-time thing or if that's consistent in order to keep the share price up. Because remember, a lot of stocks, if their dividends start dropping, that makes a lot of people nervous. They'll say, why is a dividend dropping? Which means is they're worried about future cash flow and payout ratio because the dividend amount is dropping, and that means they're really worried about, potentially, that's what a shareholder could think, and rightly so, a future cash flow because they're trying to reduce their payouts. So anyway, that's what's going on. So now what we have is some companies, what they'll do is they'll say, I'll borrow money at 5%, again, that $50,000 debt, I get to write off, and I'll use the borrowed proceeds to fund the dividends. That's just borrowing to pay debt, essentially. I'm not paying debt, but that's taking money from the future shareholders, because that has got to be paid back by somebody at some point, and giving it to the current shareholders as a form of a dividend. Now, the shareholders who receive the dividend are happy because a qualified dividend is taxed more favorably than interest, or the interest from a bond. So the folks who receive that dividend are happier, sure, because they're like, oh, I get to pay 15 cents on the dollar on the dividends, whereas before I could pay as high as 37 cents on the dollar if I received it as interest off a bond. But all you're doing is what we're doing here in the United States. We're kicking the can down the road. At some point, those debts have got to be paid, and they're going to be paid with future revenue. And if they're paid with future revenue, and that future revenue obligation grows, at some point you're not going to be able to borrow anymore in which to pay the shareholders today, but you're not going to be able to borrow anymore if you needed to borrow for operations, and that's always a problem. So dividends are better in that regard. Debt can really put you up against the wall and ultimately bankrupt you. So corporations that engage in that activity are going regularly, for sure. That's not favorable. All right. So what I want to talk about here today is I want to take my trusty pen here. I want to talk exactly how dividend works. All right, because what a lot of people get caught up is the dividend yields. All right, so let's just say you get a $100 stock and it has a $1 dividend. All right, so that's a dollar sign. So for every share costs $100, every share gets a $1 dividend. So $100 stock, every share is $100. Every share you own, you get $1. All right, so let's just say you own all of one share. You'll get $1 at the end of the year, or maybe 25 cents a quarter, whatever. At the end of the day, you're going to get $1. What's your dividend yield? I'm going to guess. I'm going to ask you to guess this. What is your dividend yield? $1 on $100 share price. And that is a dividend yield of 1%. So $100 pays $1 dividend. You have a dividend yield of 1%. Is that good, bad, or ugly? We don't know because we have nothing to compare it to. If it's compared to historical numbers, it's bad because historical numbers are 4%. But maybe it's a company that never really paid a dividend and they had a good day. So now they're paying decent amount of cash, whether they've raised decent amount of cash because they've had a good couple of years or something like that. So they're saying, hey, we've made decent money. Let's go ahead and give it back to the shareholders. All right, let's see if this can work for me here. I might need a break. It's still going to be kind of wet. All right, so now we saw before we had that $100 share price and the dollar dividend. Now, what's a way to increase the dividend yield? Because everyone's saying, I want a dividend yield. I want a higher dividend yield. Well, let's see if this works. 100, I guess, not really. Let's see. I need to dry this off a little bit and just use this piece of paper. That'll work a little bit. Should have brought there we go. Perfect. All right, there we go. All right, so what we're going to do now the share price has dropped to 50. So it went from 100 down to 50. And it still has a $1 dividend. What's the yield now, my friends? So $50 share price, $1 dividend. What's the yield? Well, the yield now is 2%. So you're still getting $1, but now the dollar is on $50 per share, so you're getting a 2% yield. All right, so the question is that good, bad, or ugly? Well, the only thing that matters is when did you buy the stock? What's your dividend yield if you were an old shareholder and bought the stock for 100? What is your dividend yield? Is it 2%? No. Because you bought it for 100. Your cost is still 100, even if the share price today is lower than 100. It's irrelevant to you as a shareholder. Only thing that matters is what you paid for it. Only thing that matters for this right here is someone who's going to buy the stock today. That could be you. You might add to your position. You say, look, I like the 2% dividend yield because I think the stock has more value to go up and I'll be able to take advantage of it. That's the only thing that matters. For you, you literally could care less what the dividend yield is today, other than the fact you are now down 50% on your share price. I mean, that's a big deal, don't get me wrong, but from pure dividend perspective, for you as a shareholder who bought the share at 100 and you got a $1 dividend, as long as that $1 dividend hasn't dropped, you're still getting a 1% yield, regardless of what the market noise is. And this is what drives me crazy. Market noise doesn't mean anything for you if you already own the shares. It means nothing, other than the concern that the share price fell 50%. Now, that might mean something. There might be some costs. I don't know. I'm just right now just talking about dividend yields. This means nothing right now for you who owned it at 100. Again, someone who's thinking about buying it today might say, that 2% dividend yield right here is awful attractive. I might buy that. All right, so what's another way we can reduce the dividend yield? Or increase or whatever. Change the dividend yield. Let's say it like that. So remember, I have my $100. That's what I bought it at. That's my cost basis. And I paid, so that's what I paid for my shares. But now let's say the dividend goes to $2. What's my dividend yield? Well, it's back to 2. It's now 2%. All right. But what if another guy remember the other guy yesterday, the last example, he bought it for $50. That's his cost. And now he's got a $2 dividend yield. What's his dividend? A $2 dividend, the dollar. What's his dividend yield? It's going to be 4%. You see how that works? Dividend yield is only based on the share price and the amount it's paying. That's it. So if it's paying $2 or it's paying $1, if it's trading at $100 or trading at $50, nothing else matters. It's just the amount of the dividend divided into the current price. That is it for today's person who's looking to invest in the company. If you already own the stock, you could literally care less. Again, other than the share price volatility, you don't care. So let me go back to another final example here, and then we'll stop this. All right, so now, again, I bought it for 100. My dividend yield was 1%. You bought it for 50. Your dividend yield is 2%. It went down. So the price per share went from 100 to 50. Now it's back up to 100. So 100, and we're going to say it's still paying $1 dividend. All right, so my dividend yield is back to 1%. So my dividend yield is down 100%, or I guess that'd be 50%. So my dividend yield dropped by 50% because the price went up. This didn't change. And because the price went up, this went down. The dividend yield went down because the price went up. So you got, it's basically like electricity. You got amps, watts, and voltage. The same thing's applicable here. You got price, dividend per share, and dividend yield. And it's like amps, watts, it's almost identical to electricity. If you got two of the three, you can figure out the other one. So if you know your amps, you know your watts, you know the volts. If you know the volts and your amps, you know the watts. You can figure that stuff out. Same thing here. If you know the price, you know the dividend that it pays, you know the yield. If you know the yield, you know the price, you'll know the amount of dollars it pays. It's literally that simple. So now my $50 guy who bought it, he's seen his price go up by 100%, and he had a 2% dividend yield before, and it still pays $1 dividend, but now that dividend yield, or he had a 2% dividend yield. Now that dividend yield, though, is back to him for 1% as well. Still 2%, excuse me, still 2%. Why? He still has a 2% dividend yield. Why? Because he bought the shares at $50. He bought it at $50. Because he bought the stock at $50, he could literally care less what the dividend yield is. He will always be getting the 2% dividend yield as long as this doesn't change. As long as the actual amount of the dividend doesn't change, he will always be getting the 2% dividend yield. It doesn't matter what it goes up to. The only thing that matters to him is he's like, man, I got 100% capital gain in this puppy. I bought it at 50, it's worth 100. I might be able to take a short-term gain on that, and that might not be a bad investment. I don't know. This guy, on the other hand, is saying, man, I had to ride it low and come back up, and I'm still where I was. Thankfully, I didn't sell it. I like the stock. But that's the problem with looking at dividend yields if you already own it. The only thing that matters, I'm going to stress this to them in the face, is the price per share. The same thing's applicable on bonds. Bonds can't go necessarily bankrupt like a stock can, but still, the same thing applies here, my friends. The price, what you paid for it, relative to the yield that you got, or the actual interest, or in this case the dividend that you got when you paid for it, will determine the yield for the rest of your ownership stake. That's it. So unless the dividend changes, or unless the interest in the bond changes, which that simply can't happen, nothing changes for you. It does not matter. So again, if you found a company that is valuable at a 1% dividend yield, and the stock drops to 50, well, now you still have a 1% dividend yield. You don't have a 2% dividend yield. It doesn't make any, for you, because you bought it at 100. It doesn't make any more or less valuable to you other than the price of the shares dropped significantly. And that may or may not have occurred for a reason. That would be why I'd wonder. It's like, is this still a good stock to own? Hope this makes sense. I get really caught up a lot in dividend questions because everyone says the dividend yield's so low. I said, yeah, no, it is historically, but so aren't interest rates. Interest rates are way low too. But if you bought the stock when the dividends were, the price was lower, say in 2009, if you bought a stock at $50 and was paying a $4 dividend, that's a dividend yield of 8% right there. Let's say you bought, I don't even know if Dominion Resource is still around, just a utility, and it was paying $4 a share, and it was only trading at $50. I'm just using that for example. Your dividend yield was 8%. If you haven't sold it and it's still paying that $4, it's probably even paying more actually, because what happens as a company starts making more and more money, they like to reward their shareholders with increasing their dividends by a quarter or 50 cents or something like that to keep up with inflation, to keep up with growth. That's a pretty good strategy right there. So if you bought it at an 8% yield and it hasn't changed its dividend, if anything, it's increased it, you're actually making more than 8% now if the dividends have improved relative to what you paid for it, which is why a long-term investor who holds dividend stocks can really make out as long as the company is well cash flow, is organized cash flow, has got a lot of good cash flow and continual cash flow. Though they don't need to go to the capital markets to raise funds, they don't need to go to the bond market necessarily to borrow. They can do it through operations. If you can find a company that increases its dividend yield just through the day-to-day operations, man, you can hold that puppy for a long, long time. And again, going back to just that example 2 seconds ago, you bought at 50, it gives you a $4 dividend, that's an 8% yield. You still purchase that 50, now it's paying $10 dividend. What's that, a 5%? I don't even know, that's a 20%, no, what is that, $10 dividend on 50? Yeah, it's a 20% yield. 20%, if it's paying 10, yeah, that's a 20% yield. That's a 20% yield. Now the price might be up to 100 and it's a 10% yield. The price might be up to 200, which is a 5% yield. Doesn't matter for you. You bought it at 50, it's paying $10 dividend. You're getting a 20% yield on that guy. Now you might have paid for a 50, 15, 20 years ago. Who cares? You get 20% dividend. Dividends are sweet. They're sweet. A lot of people are against dividends. They say they might be better used to buy back shares. I like dividends. It just keeps the company running honestly, for sure. It says, hey, we're going to have this cash. We're going to pay some of it back to the shareholder. If we neglect to do that, there'll be people wondering what the heck is going on. And that was never a good thing for a CEO and his minions who operate underneath him. They don't want shareholders beating down his door saying, hey, we bought this for the dividend. What happened? All right. Anyway, hope this helps. Don't forget to subscribe down below. Give me a thumbs up. Always helpful for sure. The whiteboard, we'll use that on occasion. Again, it's just down here in my basement, nothing fancy about this. But if you have any questions, put them in the comment section. Subscribe, hit the notification little bell there. Go to the webpage, heritagewealthplanning.com, heritagewealthplanning.com. You'll see my podcast, my blog posts, my other YouTube videos and whatnot. And we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.